Hi everyone, and welcome you to the meeting tonight on the impact of Middle East conflict on energy and fertiliser. We've a good few attendees on. I think we have 75 attendees on. So we have a couple of great speakers on tonight to make presentations, and we'll go to those in a minute. And just when we have a good cohort of members of the IFA on the meeting, I'll just give a brief. Robert Malone is here beside me as well, and Tadhg is on the call as well. We had a meeting with the Minister for Finance and the Minister for Agriculture this afternoon in the Taoiseach's office actually, and I suppose people are expecting an instant outcome from that meeting, and I suppose the reality is we'll get an outcome from that meeting, but it will take a period of time for the government to assess options that we went through with them tonight. They're looking at all measures. There was definitely carbon tax is off the table as a measure that they're willing to make any effort on. It's not going to be suspended, and it's not going to be reduced. That was made very clear by both the Minister for Agriculture and the Minister for Finance in the Taoiseach. So where we are is they've recognised that agriculture is very much exposed to the energy costs, as we'll discuss in the meeting. We are an essential service, as we would have been recognised as during COVID. They are looking at all measures that would make a tangible difference, and that was the point we were making. We've seen a 60% increase in the cost of diesel in particular in Ireland, and we need something that's going to make a tangible difference to the cost on farm. Credit is an issue, and they're going to try and give us some support and look at options on credit that's going to have to be carried by contractors and going to be paid by farmers down the line. They're very aware of the situation. They're very aware of the urgency of the situation, that the diesel will be burnt over the coming weeks and months, will be the vast majority of the diesel that will be used across the year as we make silage. So I don't have good news other than we have more meetings lined up with both ministers, and we are continuing to engage, and we have an open line of communication to make more suggestions and to give feedback over and back as to what we may be able to do going forward. They are having a look in particular at the carbon tax relief that farmers get, looking at the option of making that relief available to contractors if that's legally allowed under current rules. And there may be energy reliefs that will come into play from an EU level, and if they come into play, they would make a tangible difference. But at the moment, we don't have anything that's going to happen in the next few days coming out from that meeting, but we are all continuing to work on reliefs going forward and on any measures that can be used to reduce the cost on farm and with contractors. So I'll leave it at that. We're going to have two presentations from Standard & Poor's global experts on energy and fertiliser costs. The first person to present is Daniel Evans on energy costs, gas and oil costs across the world. We'll take questions at the end of this. The questions come in through a chat function that Robert Malone will moderate beside me, and we'll feed those through to the speakers. We'll take both a presentation on fuel and fertiliser first, and then we'll move over to Tadhg afterwards. We'll take the questions before Tadhg. Okay, so thanks very much, Daniel. I'll ask you to give your presentation first, if that's okay. Daniel Evans from Standard & Poor's, and you might introduce yourself as well, Daniel. Thanks.
Yeah, great. Thank you very much. And just checking, you can see the slides okay? Perfect.
Yeah.
Well, I'm afraid I don't have a lot of good news either. I mean, I think the tone I'm going to try to strike in this presentation, I would say, is appropriately alarmist. These are, I think, very difficult times for your industry, but also for consumers around the world. And I don't think it's worth sugarcoating it. I think it's worth being pretty frank about how we see the situation and what are the different ways in which it could evolve, and what might that mean for you in terms of energy prices and also energy availability. So my name's Daniel Evans, and I look after the refined product portion of our oil research. So I'm part of a big energy researching team at S&P. And what I've tried to do here is bring together some of the ways that we're thinking about both the oil and the gas market, to give you some of the bigger picture of what's happening in the Middle East, is filtering down into the energy prices that you're seeing in Ireland, and also sort of raise the question around the potential concerns about supply. So I think where we are is that, diesel prices, as you said, the prices you're seeing have risen 60%. The gas price, the European gas price has doubled. I think there are really legitimate concerns about whether molecules are going to continue to be delivered if this situation continues. And I think our read of the situation is really that the market hasn't quite grasped just how bad this situation could get. So when we look at the oil price, for example, when we look at some of the equity prices, we really don't think a sort of worst case scenario is baked in at all. So in other words, there is more potential upside on price should this situation continue, and should the conflict escalate even further than where it is today. So I'm going to start on oil, then I'll turn to gas. So, I mean, just to put this in context, right, maybe in a historical context, I mean, our read is that this is the biggest oil shock ever. So bigger than what we saw in the 70s with the embargo, bigger than what we saw through the Iran-Iraq war, and bigger than what we saw in the Gulf War. The volumes of oil that are trapped inside the Persian Gulf are huge, right? So we're talking 20 million barrels a day, 20% of the global market. And the reality is that there's just no way for those volumes to get outside of the Gulf. And so duration is really the key here, because we do have buffers in terms of inventories, emergency inventories that can be drawn down, commercial inventories that can be drawn down, even inventories that consumers hold. But once that buffer starts drawing down, really the only way that the market can rebalance is via destroying demand. And I'll come back and talk about the potential mechanisms for that a little later. Now, one of the reasons why we feel that there is potentially more disruption on the horizon is that the ships that left the Gulf at the end of February are still arriving. So it typically takes, for example, for a tanker to leave the Persian Gulf, to go around the southern tip of Africa, and to arrive in Northwest Europe could be 40 to 50 days. So we're heading towards a cliff edge, and as you can see from this chart, the tanker traffic has basically gone to zero. So in the next week, the next 2 weeks, that last bit of supply that was coming out of the Middle East is going to dry up, and that's when, in our view, we'll start to see real concerns about the physical availability of diesel starting to emerge in the market. The Middle East, so this chart is a little bit complicated, but basically it's showing the production of refined products in the Middle East, what they're producing and where it's going. I think from a European perspective, the main message is that the Middle East is an important supplier of diesel into Europe. And it's become even more so in the wake of the Russia-Ukraine war, where we basically kind of cut ourselves off from Russia, which was a big supplier. The problem, sort of looking forward, is that there really are not a lot of places where we can turn to pull this supply. So we can get a bit from the US, but what we're starting to see, sort of worryingly, is that a number of countries who are big refiners and big exporters of product, like China, like Korea, they're basically hoarding product, banning exports, keeping those molecules for themselves. So this is worrying behavior that could exacerbate supply shortage concerns in countries that are net importers. So this matters because there is, I would say, sort of three layers of impact into the global diesel market. The first is, you've got refineries in the Gulf that can no longer export, so they're being forced to reduce their operations. Basically, their tanks are full. There's nowhere for that product to go. You've got 12% of the world's refineries that are potentially under attack from Iranian missiles and drones, and we've seen refineries even outside of the Persian Gulf being attacked, being hit. That has a short-term impact, but also a potentially longer-term impact. And then you've got another 40% of the world's refining system, which is running some share of Middle Eastern crude. And what we're seeing there is that as those crude oil supplies dry up, those refiners cannot run as hard as they were. They cannot produce as much diesel as they were, and so there's less supply coming into the market. So all of these three transmission mechanisms are basically leading to a situation where we've got less diesel entering the global market. So where are we in the crisis? I mean, I said duration is really important here.
Just Daniel, sorry to interrupt. Are your slides frozen there? You're still on lagged impact there of vessels?
Oh, sorry. Let me stop sharing and
Start.
I think we may have temporarily lost Daniel.
Yeah, it looks like it.
We'll just give him a minute to see can he come back online. Yeah. We could go over to Angelo for a presentation on fertilizer. We'll give it 1 more minute and just see what happens.
Bill, we just
just
hang on a second, Bill, because I just see he seems to have gone out of the meeting, but his slide is still up. Okay. So that could be.
Yeah. Okay.
No. So hopefully he might be able to get back in now. Hopefully.
We'll just get him to run through those last couple of slides quickly if he can come back in. Technology is great when it goes the right direction. Alan, you're there. Would you like to comment on anything on those earlier slides? Just that supply falling off seems to be a big shock. Like that's the same around the country. Those ships will be going longer distances and taking longer to get to other parts of the country. But we're seeing shortages in Australia and that already. Are we? Is that going to just come off the cliff?
Yes. So the issue of the Strait of Hormuz in terms of shipping anything, and Angelo's going to comment a little bit about the fertilizer side of it. Fundamentally, that is the key issue that is going to impact on all of us for some time to come. And I mean, I've not had a preview of what Daniel was going to say, but one of the things that concerns me in particular is that like Pandora's box, once it's open and malign states might see that they've got a way of holding the global economy to ransom, that's not an easy thing to get past. So one of the things that it's not self-evident to me at the moment, but you've got to hope and pray for, is that what comes out of this is a properly negotiated settlement that everyone can live with, because otherwise every time someone gets annoyed around there, the Strait of Hormuz is going to close again, isn't it? So I think as I say, I haven't seen a preview of what he was saying, but the part of the statement around this is probably the worst oil shock we've ever seen, I think is probably predicated around that, because we've never seen this ability to just completely stop a major element of global oil and gas flows.
Yeah, I think the point was made to us in our meeting earlier that this energy crisis is equivalent to the last 3 energy crises we would have had over the last 50 years, all put together. It's that huge an impact on the world. I think maybe we'll go on to Daniel.
Angelo.
I think we'll go on to Daniel. I see Daniel back there now.
Yeah,
I apologize. I'm sort of struggling with my computer here. It's it kicked me out. So I'm not sure I'm going to be able to bring the slides up, but I can talk you through the
talk us through it. Yeah, perfect.
Yeah. Okay. I really apologize for that. So I was going to sort of just to the point where I was going to say, where are we in this crisis? I think what initially started as a flow crisis, so was really a logistical constraint, quickly became a supply crisis. So due to that bottleneck, we saw oil producers having to shut in fields. We saw refiners having to shut in refineries. And that sort of bought us a bit of time. But I think quickly what we're seeing is that this is going to become a demand crisis. So if there's not enough supply, demand is going to have to adjust to rebalance against that. I think there are really 3 mechanisms that we can see that will rebalance demand. One is higher prices. Higher prices will lead to consumers reducing their consumption. We're also likely to see some rationing. So we're already starting to see in some countries there is rationing, and then finally there's just not going to be enough molecules to arrive. So governments are going to need to step in. I think our view is that if this situation continues, we're talking about something close to 15-20 million barrels a day of oil demand that will eventually need to be rebalanced against the supply. So that's a volume similar to what we saw during the pandemic. And we all know what that meant in terms of restrictions on travel and so on. So I would say the difference between the situation now and the situation in the pandemic was that the pandemic was a managed demand destruction, and there is the potential that this is unmanaged, or essentially it becomes a battle for who can get hold of these molecules and who goes short. So to wrap up on the oil side, I think from an Irish perspective, the price is clearly one impact. So I think we see further upside to price in a situation where supply remains constrained. It can come down fairly quickly once that bottleneck is removed. But the longer I would say the longer the disruption persists, the longer the time the market will take to get back to normal levels. So a potential impact on price. But I think we shouldn't rule out a situation where governments have to prioritize which sectors energy is being delivered to. We're seeing that in other countries where, in India, for example, they don't have enough LPG. Residential consumers are being prioritized over businesses. So that's the type of trade-off that the governments may have to make. On the gas side, Ireland is importing its gas via the UK. The UK is an importer, or was an importer, of Qatari LNG. That supply is no longer getting there. But I would say that supply was only a small part of the UK's gas supply. And the UK wasn't even taking up its full allotment of supply from Qatar. So I'd say the issue is sort of less acute on the gas side. What we've seen since the Russia-Ukraine war started was that UK demand for gas has fallen quite significantly. And in the summer months, certainly the UK is a net exporter of gas, not just towards Ireland, but towards continental towards continental Europe. So from a physical supply perspective, there's no real concern, I would say, through the summer months. Maybe becomes a bit more of a problem if supply is still disrupted into the winter. But in that case, our view is really that price does the work. So if the UK is willing to pay more, it can pull more gas from continental Europe, from Norway, and then re-export that towards Ireland. So maybe I would be, if I contrast this a little bit with the diesel situation, maybe a little bit less concerned about the physical availability of gas. But I think the price concern remains, right? It's likely that we're going to be in this elevated price scenario until the bottleneck has really been removed here. So apologies for the lack of the slides or the disruption to the slides. I'll make sure that we send them across to you so that you do have them. Tadhg, do you want to come in?
Yeah, I suppose I was just going to ask you. Thanks, Daniel. I was just going to ask two quick questions. We get most of our oil as well effectively refined from the UK, and you mentioned about demand destruction or demand restrictions. Do you see a scenario where you could, like, I suppose if you have demand restrictions coming in the likes of the UK, it's then it potentially could spill over across to here. Do you think that it's a realistic scenario that you could see demand restrictions being put in place in the UK, given we're less exposed from a supply perspective than, say, the likes of Asia and Australia, New Zealand? Or could you still see it happening? And a second question I was going to ask you was kind of linked. Say the thing resolves itself in the Strait of Hormuz. I presume it won't overnight flip back. It's going to take a lot of time, because a lot of these oil tankers obviously take a lot of time to go. So even if the thing gets resolved, what sort of wind out period do you think is going to be there, both on oil and on the gas? Then is it going to be more medium term with gas, given that there seems more infrastructure damage done on the gas side of it than the oil side of it?
Yeah. So two really, really interesting questions. So I think first of all, on the question of the sort of, would the UK effectively, I guess, restrict exports to Ireland in the case where supply becomes constrained? I think actually we're likely to see more solidarity, I would say, in the European context in terms of having a more coordinated response within the framework of the IEA, for example, than we've seen in Asia. So I would not necessarily expect European countries to sort of go their own way on this in a way that really kind of pushes the pain into neighboring countries. So I would say I'm not terribly concerned about that, but I think you're right to have it on your radar. In terms of the delay, again, right, I think you're absolutely right. We've got close to 400 ships trapped inside the Strait of Hormuz. Even if the strait fully opened tonight, it takes several weeks to clear that backlog. So our view is that the energy cargoes would be prioritized. But as you said, right, we've now got a 4-5 week gap in supply. So even a vessel that sort of leaves the strait tonight is not going to arrive in Ireland until the middle of May. So there's going to be a gap from a logistical perspective, and then I think we also have a potential supply gap because it's not that easy to restart an oil field or restart a refinery. So those things take time. So I would say that the fear factor is likely to come out of the market pretty quickly, but it's likely that we're still going to see prices higher than we would have previously expected because we've got less supply and we've got lower inventories because we've been pulling from storage tanks for the last few weeks.
Perfect. Thanks very much, Daniel. We'll hold you there, Daniel, and we'll go to Angelo Salton first to present on fertilizer.
Just to say, Bill, if anybody wants to put in a question, please use the Q&A tab on the top of your team screen rather than the chat tab, just the Q&A function if you can.
Perfect. So we go to Angelo Salton, Standard & Poor's global expert on fertilizers, and we also have Alan Pickett in the background to answer questions afterwards. So we'll have three voices answering questions afterwards, but we'll go to Angelo first. Thanks.
Thank you, Robert. Yeah, thank you all for having me. I hope you can see the presentation by now.
Yeah.
Yes.
Please let me know. Okay, thank you. So yes, thank you again. I'm Angelo, analyst for sulfur and phosphate raw materials. I work alongside Alan Pickett, and I'm based in Brazil. So for today's agenda, I will cover the latest developments in fertilizer markets, also raw materials, which is going to be an important topic here, and also provide some perspectives moving forward. So I want to start you by showing you the big picture and what are currently the impacts. So as you can see, quite significant portion of global fertilizer trade is concentrated also in passing through the Strait of Hormuz. As you can see, 35% of global urea trade and a quarter of DAP passes through the strait. Also, as you can see, from multiple, we got multiple producers there of various fertilizers and raw materials, especially sulfur, which is to me a critical raw material, which I will discuss further later. But I can tell you that we see two main impacts. A first order impact is, of course, the amount of supply that is lost given the disruptions. As you can see, millions and millions of tons. Saudi Arabia potentially can reroute some exports through the Red Sea, through the other side, but still not enough to account for the losses of all supply. And also importantly, as you can see, Iran is also a provider. Iran itself is also a provider to the market, both on the fertilizer and the raw material space. So this is the first order effect, which has impacted global prices due to importance of the region in trade. And the second order impact is, of course, the disruptions to oil and gas and potentially the impact on the cost of natural gas as a feedstock. So to produce urea, you need ammonia, so you need natural gas. Same thing for ammoniated phosphates. So, and also you'll get all the impacts of shortages of diesel and other heavy fuels on seaborne transportation and also overland freight. So speaking about prices, as also worth mentioning here, the chart on the right shows a little bit of perspective on prices that S&P Global assesses on a weekly basis. So you can see that both nitrogen and phosphate fertilizers experienced a shock short after the blockade in the Middle East. The timing of this disruption is also important because we also, from the demand side, have important markets such as Brazil, India. Brazil is currently in between seasons, but India is an important consumer of urea and usually sets the tone through its large quantity tenders with participation from the government. And it doesn't have large stockpiles of nitrogen fertilizer at the moment, so they were expected to return to the market soon. And also because of problems with, of course, natural gas supplies, their own domestic nitrogen production is plunging, as we've seen from latest statistics. And in that case, also on the phosphate front, we've got, as shown before, Saudi Arabia as an important exporter of phosphates. So similarly, we had similar shocks in prices. At the moment, a good amount of importer markets are covered, like in nitrogen, and there are some alternative suppliers in the market. But still, given how much supply was lost overnight, prices globally increased in response to those developments. The price charts also shows you some perspective because we've got some price history from the Russian invasion of Ukraine. So you can see how much potential there is for prices to accelerate further. I'm saying that partly because back then we had a kind of shortage through problems with financing and Russian access to finance. But right now we have a physical supply shortage of product coming out from the region. And on the potash front, the impact is limited because suppliers in the region have alternative routes, and so there's less exposure from that nutrient. Still on the nitrogen front, I believe that this could further push a shift from calcium and ammonium nitrate CAN to urea, because in the presence of carbon tax, and we've seen this recently, there's been a shift from CAN to urea because the default benchmark values for carbon are lower for granular urea than CAN. On the raw materials front, the situation, and also adding to what Daniel said, the situation is critical because ammonia is linked to natural gas. So it must compete with other end uses of natural gas. And often when compared to heating and residential use, synthetic fertilizers does not rank as highly in that regard. Also, as a very likely result, we've got CAN costs in Northwestern Europe to accelerate because of issues with ammonia. In Belgium, Netherlands, we have also Spain, we have CAN producers who both deal with imported ammonia and some others who produced on-site. So on-site producers, they are a little bit more shielded from price variations because they often secure long-term gas contracts. But in the potential absence of physical product and also renegotiation of such contracts, they are likely to face the same issues with costs as well. And similarly, with phosphates, it's also disturbed because ammonia is used in the production processes as well. And finally, outside of the fertilizer world, ammonia is also used in various other end uses to produce fibers, plastics, nylon 6, caprolactam, and other basic chemicals. And also, the price chart shows that sulfur, this one was like the final nail on the coffin because the sulfur market was already challenged by various supply issues from Russia and also firm demand from Indonesia in the metal sector for the processing of nickel and also in other regions copper as well. But the most critical situation, as I showed before, in terms of shortage is sulfur, because the Middle East concentrates such a large amount of trade since elemental sulfur is a byproduct of oil and gas processing. So it's an inevitable result. And also sulfuric acid, which is also called the king of chemicals, is produced, a large part of it is produced from burning of elemental sulfur. So we have higher costs that are passed along to the value chain. And finally, to provide some perspectives, as Daniel said, and also it's an inevitable link. So further price direction is, of course, linked to the duration of the restrictions on the strait. So we've seen U.S. troop movements going to the Middle East with land troops. We have Donald Trump's track record of operations elsewhere, like in Venezuela, and also the potential of Iran to counterattack. This all has led me, along with a few colleagues, to believe in that the situation could be prolonged for a few more weeks. Today, Trump is going to address the nation in a speech, and he will probably show a little bit more about his strategy. Of course, words and actions are two different things, but there are very high expectations around that. And also an important thing to mention is the relationship between crop and fertilizer prices, because we have this shock in production costs in agriculture because of fertilizer, and also pesticides as well because of chemicals. But the situation in the food space is that in the northern hemisphere, in the US crop, the near-term fertilizer requirements are pretty much fulfilled, and also we have higher passing stocks of grains and oilseeds commodities than in previous years. So if you see the crop futures, there's a modest reaction to this whole crisis. And in the sense, any demand destruction on fertilizer sector is to become more evident further through the year. And also as a result, there might be changes in planting intentions, because we've got some crops are more intensive in nutrition than others. And also you have in places like Brazil, US, you have biofuel policies and incentives that could change, for example, the decision between corn and soybeans, and then with implications for demand. But overall, it is also understood that this higher energy in terms of fuel prices leading to inflation because of transportation costs, and in the sense, fertilizers are part of this of the global energy wheel because of their connections through raw materials and agriculture, if you think of it as part of a larger energy context. So in the sense, we believe to some extent that further through the year, we'll see the economic cycles being put in action, since at current levels, the fertilizers become unaffordable. We see potential demand destruction and an inevitable price correction. But the initial shock, and we continue to witness week after week pricing ideas for fertilizers in international trade getting higher and higher. And over the long term, and this is what I have been highlighting here on the right-hand side, are potential risks and strategies. So because of these high prices in the international market, we expect that large exporters and producers of fertilizers, which also large consumers such as China and even the West, to be more protective about their domestic supplies and restricting exports. And also the more unstable macroeconomic environment to limit a little bit of further projects. And in terms of strategies, bundling of large purchases through cooperatives is to become even more important due to higher bargaining power. And it's quite usual that when the price of chemical or mineral fertilizers increase, that farmers look for sustainable alternatives. And of course, we expect that organic alternatives to be priced accordingly. And finally, in the fertilizer space, we've seen that this evidence of a shift from free trade to more protective, more protection in terms of trade policy around fertilizer exports to secure domestic supplies. And finally, any technological advancements on the fertilizer sector, they gain strength because the price of mineral fertilizers, they increased overall. So to summarize, we expect a self-correcting mechanism in the fertilizer space because more advanced farmers throughout the world and near the technological frontier to be able to consume a little less fertilizer with minimal impact on yields. But as the conflict drags on, the prices continue to increase and the situation aggravates even further. And yes, and in this sense, I finished my presentation, and thank you, and of course, open to questions.
Perfect. Thanks very much, Angelo. We have a couple of questions coming in on the chat, so I might ask Robert just to put on a couple of questions.
Thanks very much to both our presenters. Just a good few questions about our supply and reserve in Ireland. I'm not sure if you can answer this directly, but a lot of people are very concerned about how exposed is Ireland in terms of our storage. We're told we might have a 90-day storage, but that mightn't be all on the island of Ireland. In particular, there's a lot of concern about the storage and reserve of liquid petroleum gas in Ireland, which we're reliant on imports from the UK, as you said. I'm not sure it's something that maybe Alan might be able to answer.
No, you're talking gas here. This is definitely in Daniel's territory.
Okay, Daniel.
Possibly, yeah.
Yeah. So in terms of the Irish storage buffer, when you look at it on a kind of for diesel, I looked at it so sort of 120 days worth of diesel supply for Ireland held in tanks in Ireland. I'm not sure on the LPG number. I can check on that and get back to you. I think this is one of the problems with the strategic storage, because countries do have, whilst they have an obligation to hold 90 days of imports or 90 days of demand, they have choice in terms of whether that's crude or products, or which refined products it might be. So you can have a situation where although on paper a country is covered by well over the required level, certain sectors are more exposed than others, and that's what we're seeing in the aviation sector, for example. I'll follow up on the LPG issue. I would say it's not necessarily a problem if those stocks are held somewhere else. That's fairly common for IEA member countries to hold their strategic reserves in third-party countries. So a lot of reserves are held in the Netherlands and in Belgium, where there's huge storage farms. That shouldn't create an issue, to my mind.
Okay, thanks, Daniel. And again, Daniel, just on terms of our energy generation in Ireland, it's a question, does a lot of our generation come from the energy source is LNG or liquid natural gas? And if that becomes, supply becomes an issue, is there a possibility of energy prices or electricity prices rising on the back of this when gas prices eventually do rise? And would that possibly that rationing be implemented in gas? And also on poultry, our poultry farmers in the broiler sector are reliant on LPG. You kind of answered that, but I don't think we have. I'm fairly certain we have very little storage on national storage for LPG. You kind of said you'd have a look at that. It might be off country, but it's something we've always been exposed, I think, on LPG gas storage.
Yeah. I mean, I guess the short answer is that higher gas prices will translate into higher electricity prices, because when the price is typically set off the most expensive way of producing electricity on a European basis. And so when gas becomes the most expensive way of generating electricity, that feeds through into the electricity prices. So unfortunately, this is an energy crisis where there's really sort of nowhere to hide, whether you're looking at oil or gas or biofuels or electricity, that they're all going up.
We had just one from a silage contractor on supply of diesel oil for the silage season, which is fast approaching. It's actually something we discussed with our Minister for Finance and Minister for Agriculture less than an hour ago. And the question was, do you think agriculture and contractors will be prioritised? We've asked for that. That's kind of preempting a shortage, which we're not there yet. So we have asked for that, and we've got commitment that they would consider, similar to when in COVID, agriculture farm workers and contractors were considered frontline workers.
Can you explain the impact that India would have on the fertilizer market? So that's the question for Angelo coming in. And just to make that point, we did ask the question, and maybe Daniel, if you can hold that question as well, is we asked the government, are they considering asking people to go on a 3 or 4 day working week to reduce demand and to reduce consumption in general? And is that probably a good policy to try and get out ahead of this real supply crisis that may be coming down the line before it gets too bad? Should we be looking at doing that as a country? We did ask the Tánaiste to that today in the meeting earlier.
You want me to answer that before you go to Angelo?
Yeah.
Yes, I mean, I think governments are going to be forced to take difficult decisions, and that there are going to have to be trade-offs here. I think that's asking people to work from home is, given the recent experience of the pandemic, where it worked pretty well and was not terribly disruptive to the economy. That to me seems a lower pain solution than impacting industry or agriculture. So I would certainly, in a world where there are no good choices, I would say that's one of the less painful ones that you can ask people to make.
Okay. And do we have enough?
And we're seeing other countries do that. We're already seeing other countries take that stance, ask people to work from home, asking people to travel less.
Okay. And the question was, do we have enough of a supply of green diesel for the silage season available to where? I won't say that it's in the country, but is it available if these tankers stop moving? May, June,
I would say should be fine. May and June. I think the issue there is going to be price rather than availability. And if this conflict continues and if the strait remains closed, when the storage starts drawing down at a global level, that's going to support higher prices. So even if you don't have a physical supply disruption in June, it's possible that if you're going to see even higher prices than we have today because of the perspective that there's no end in sight and the clock is ticking on a supply disruption.
Okay, and I just ask Angelo to answer the question. We'll go to Tadhg then. Will India have a big impact on the fertilizer market in Ireland, in Europe, but in Ireland in particular?
Do you want me to take that, Angelo?
Or whatever.
Yeah, why not?
Okay, so India will have an impact, but possibly less than you might immediately think. So India has been taking urea from the Gulf, and there will be issues around that. However, since COVID, India has also commissioned four new 2.5 million ton urea production units. So over the last 4 or 5 years, they've put in an additional 10 million tons of urea. There could obviously be issues in terms of sourcing gas for those, but they will prioritize gas usage as they see fit. In addition, over the last 3 or 4 years, Nigeria has brought 2 world-scale urea plants on stream, which are primarily export oriented. So I would imagine that there are quite a few Nigerian salespeople for urea currently making their way to Europe to offer services. I think from the immediate impact of what's going on in the Straits of Hormuz is possibly being delayed for fertilizers because the Northern Hemisphere application season, a lot of the product was already in place by the time this kicked off. And so there will be a little bit of disruption around that, but for the main chunk of Northern Hemisphere application, there should be enough tons of material available. However, because of what's happening with gas prices, and especially because of what's happening with sulfur availability, there is some existential problems coming down the pipe in terms of production. So many of you will be aware that the European nitrogen industry has had major problems post the start of the war in Ukraine because of gas supply and gas prices. This is not going to help that situation one little bit. And the significance for you guys in Ireland about that is that calcium ammonium nitrate is still a well-used and popular product. And whilst urea is a genuinely global product in terms of production, and there are plenty of other export-oriented producers outside the Persian Gulf, for nitrate production, it's essentially a game between the Russians, Europe, and the Americans in North America. If we're not buying from the Russians any longer, and the European supply side is severely curtailed because of gas prices and the competitiveness of ammonia, the only other alternative is the United States, and the United States is not big on CAN anyway. It's mostly ammonium nitrate it's producing. So I don't think there are going to be massive problems for the remaining part of the spring application season, but for Ireland in particular and all of Europe thereafter, so for autumn application and going into next spring, if this doesn't get resolved quickly, then things could get very, very difficult in terms of some of those products.
Perfect.
Urea less so, and because of Chinese lack of interest in ammonium sulfate and the fact that they produce quite a lot of it as a co-product, there should also be a regular stream of Chinese ammonium sulfate available if that's of any interest to people.
Okay, our fertilizer importers will have to add Nigerian to their Google Translate apps. Tadhg, we'll bring you in there. You wanted a comment there?
I suppose I had two questions. There was a question there asked by one of our attendees, and maybe Daniel might take it. Are governments understating what's coming down the track in terms of potential oil supply issues to try and avoid panicking the market or avoid a run on oil? And I suppose just on fertilizer, Alan, you more or less answered the question I was going to ask there on the supply, more or less. But I suppose two things I was going to ask your opinion on. First of all, on phosphorus, like you mentioned, is about urea. Is how are we looking? Is phosphorus an issue, or phosphorus-based product? And second of all, the whole CBAM issue in Europe. I mean, I suppose you couldn't pick the worst time to bring in CBAM into Europe if you think about I mean, that's maybe I'm incorrect in that view, but when I look at the impact that's had in terms of disrupting the fertilizer trade in Europe, and I'd just be interested in your views on what role CBAM might play in this whole fertilizer issue that we're facing at the moment. Obviously, that's a big problem. They're trying to import CAN into Europe as well, I'd imagine. Thanks, Alan.
Daniel, do you want to deal with panic buying first?
Yeah, sure. So I'm not sure whether governments are deliberately, kind of glossing over the severity of the situation, or whether they're just not fully appreciating how historic the situation that we're facing is. I mean, I started off by saying, this is the biggest energy market shock ever. And I think that, if you look at how governments responded in the 70s, one of the things that they did was sort of set up institutional frameworks and organizations like the IEA to manage subsequent energy crises, and they did pretty well at doing that. So in a way, there's not a lot of institutional memory of crises of this magnitude, and I think it's not just politicians, but if you look at the financial markets and even the oil market, I think we would argue that the potential for disruption is not fully priced in. So there may be some element of not being totally aware of the kind of cliff edge that we're running towards. There may be some element of wishful thinking that, Donald Trump tonight might say it's all over and things might go back to normal. But I think the reality that we're looking at as analysts is that there is no easy way out of this. And in a way, even if the conflict ends, the situation is going to be worse than the one that we started in, right? The Iranians are going to have leverage over, they know they have leverage over the global economy, over energy supply now. So it's going to be a tricky situation. And as we were just discussing around the work from home requirement, governments are going to be forced to take difficult decisions, and I'm not sure they have the answers to those trade-offs right now. So I'm not sure it's a Machiavellian instinct on the part of the politicians rather than just sort of not fully confronting the severity of the issue just yet. But which is why I think the conversations that you're having with them and other industrial stakeholders are having with governments are really important, because I think they do need help in terms of being guided with regards to where this is being most keenly felt in the economy, and by what actions they can take to have maximum impact on reducing some of the pressure.
And Alan, did you want to address the CBAM?
Well, there was phosphates as well. So briefly, phosphates from a supply perspective, there is one producer in Saudi Arabian mining company, Ma'aden. They account for around about 11% of total trade in all phosphate fertilizer products. So in themselves, if Ma'aden's not supplying the market for any length of time, it's awkward, but it's not a disaster by any stretch of the imagination. The big existential problem, though, is that to make phosphate fertilizers, essentially you're neutralizing phosphoric acid with ammonia to make an ammoniated phosphate. And to make phosphoric acid, you need to take up a phosphate resource like phosphate rock and acidulate it with sulfuric acid. So for every 1 ton of P2O5 in phosphoric acid you're producing, you need 1 ton of sulfur. Or alternatively, for every ton of DAP that you're buying, you've used 460 kilos of sulfur to make it. And as Angelo showed in this slide, something between 45 and 47% of global sulfur traded every year goes through the Gulf of Hormuz. So if phosphate producers can't get sulfur from the Gulf, they can't supplement it with supply from elsewhere. I mean, that's just not possible. And then the second problem associated with it is that sulfur and sulfuric acid are also used in leach processes for base metal production. Think copper, nickel, products like that. And guess what? That market pays a lot more for, or is a lot more profitable than fertilizers are. So if you've got competition out there for sulfur, the base metal guys are going to win every day of the week. In terms of value. So that's a challenge. With CBAM, I don't have a position to speak for the European nitrogen industry, but unless Europe rescinds everything that it's doing on carbon taxes, if it were to get rid of CBAM, essentially you are going to kiss goodbye to a European nitrogen fertilizer base, which might mean temporarily in 2026 you got a few cheaper tons of fertilizer, but boy oh boy are you storing up a problem for the future. So I don't see that as being a rounded solution to this. Clearly there are arguments about carbon taxes, but if you're going to have carbon taxes on European production, in order for there to be a fair playing field and to enable and continue with the European industry for production, you've got to make sure that imports pay commensurate carbon taxes as well. That there are arguments about this in the EU are absolutely certain. I mean, we've been in rooms where the EU Environment Directorate and the Fertiliser Farming Agriculture Directorate have been arguing hammer and tongs over this. You know, one saying, well, you're going to kill the nitrogen industry, and the other saying, but the whole point is we need to reduce carbon emissions, you know. So I would be sorry.
Yeah, no, we'll take two more questions and that'll come in again, Alan, so that's fine. We'll go to Tadhg then. And just the two questions. One of the questions is what's the lead time likely to reinstate stable supply chains for fuel and fertilizer? We kind of know the fuel is probably 5 weeks after conflict would end, we'd have 6 weeks. But fertilizer, I just either Angelo or Alan to comment on that. Like, we could be looking at a serious problem with fertilizer supply for the next 12 months because they've stopped making it, and it'll create a problem. And after previous conflict, we've seen large oil and gas companies record profits. Is there any mechanisms for governments in the EU to monitor this? And look, I'm going to add, it's a comment that the fertilizer companies that we're trying to protect in Europe with the likes of the CBAM levy and the anti-dumping tariff, they made record profits in 2022. They had previously bought gas cheap, sold the gas dear on the world market, bought back gas dear to make our fertilizer, and made us pay dear for the fertilizer. So there's no love lost in Ireland between Ireland and the European fertilizer industry, just to be very clear on that. We know where we stand with them. They're hard-nosed business people. They'll make money no matter what, and they're lobbying very hard for the likes of the CBAM levy to be in place. But just a comment on the record profits from oil companies. Would we have oversight of that at the EU level? And what's the lead time likely, I would say, on fertilizer across the rest of the year and into next year?
So with fertilizer supply, I mean, again, it's a broad church. So if you're talking about potash, there shouldn't be any particular issues in potash supply at all, because it's not affected by what's going on in the Gulf, with the one exception that if energy costs change, the cost of mining and milling potash will change a bit. But you're talking probably changes in costs of a few tens of dollars per ton. Kind of, it's not a big issue. For nitrogen, the big issue in terms of the supply of nitrogen is not so much bringing it back on stream, it's at what cost and price. So, you know, that the guys will make the stuff if they can turn a buck, but you know, if they start coming to you and saying, okay, it's 600 or 700 euro a ton of CAN, you're probably going to say no, thank you. So, you know, it's that balance there in terms of whether they can get gas at a cheap enough price for it to be profitable through the whole chain. In other words, for farmers to be able to say, yeah, I can afford to buy it at that price. With phosphates, the biggest challenge will be undoubtedly how quickly assets in the Middle East come back on stream and start producing, because the sulfur is a byproduct of oil and gas refining. So if the refineries are not refining, they're not taking sulfur out of the gas streams, which means that the sulfur isn't available. So it's a factor of how quickly those refineries and gas processing units come back on stream. However, from there, it's then roughly 2 or 3 weeks around to, let's call it Morocco as a major producer. And then you've got to make the stuff in Morocco, and then you've got to export it to Europe. So you're looking at, I would say, 4 to 5 months to get things back onto an even keel overall. Which, again, from a European perspective, may not be. I mean, if this gets resolved in the next few weeks, it's then maybe not so much of a big issue, because by the time the big buying times for fertilizers come around again, probably everything is resolved. But if some of the core structural issues there in terms of cost remain, then we've made the position relatively clear on that. Sorry, the CBAM question was?
No, I think you answered.
Okay.
Well, did you answer the CBAM question earlier?
Okay.
No, that's okay. And no, the other question was on profits. If Daniel wants to comment on that, on the profit soil companies, would we have oversight in the EU over that?
Yeah, so maybe just quickly a kind of a clarification on what I previously said about how long it would take for the energy flows to come back. So there's definitely a scenario where the logistics is able to adjust relatively quickly within that sort of 5-6 week timeline. But similar to what Alan just described on the fertilizer side, if we're losing production capacity, we need to restart oil fields, need to restart refineries. That timeline will be stretched into several months, potentially longer. On the windfall tax, maybe I'll just tell you a quick anecdote that might answer this question. So last week I was in Houston, and I talked to a European oil company, and I asked them, are you talking to government about how to manage this crisis? He said, yes, we're talking to them about how to manage the crisis, but the only thing they want to talk to us about is a windfall tax. So yes, I would say governments are definitely watching the energy profits very closely and thinking about how to kind of bring some of that money back.
Okay, look, I'd just like to say thanks very, very much to our speakers tonight. They're more than welcome to stay on the call if you want to listen in on the rest of the meeting. But look at a huge expertise there. We may call on you again as time goes on. We don't know how long this conflict is going to go on. We don't know how long it's going to last or what the impacts are going to be down the line. But a huge thanks from everyone on the call. I think we have 185 people on the call, so that will just show how important it is in the country. That's a huge meeting for the IFA. So I'll thank you very much. You're more than welcome to stay on the call, and we'll go to Tadhg's presentation if that's okay, Tadhg. And thanks, lads. Thank you very much.
Thank you very much.
Thank you.
Thanks very much. Thanks very much, Bill, and thanks to Angelo, Dave, Daniel, and Alan as well for it's very interesting and really very insightful information there. So, can you see my screen there? Yeah. So yeah. I suppose I'm just going to talk a bit about just from an Irish context, in terms of we just did a small bit of work ourselves in terms of what potential impact it could have on Irish farming sectors, and I suppose a bit as well about what we think could be done in terms of from an intervention perspective to try and alleviate the biggest the worst impacts of this. So I suppose first of all, just to say, in terms of from an agriculture perspective, the direct impacts, a lot of this has been covered already, but obviously we've got the availability and cost of energy and energy products and of nitrogen fertilizers. And it's beyond nitrogen fertilizers when you hear about the insight that Alan and Angelo have given us as well, and particularly the link between sulfur and phosphorus, which or phosphate, which I didn't fully appreciate. We've got the disruption of trade flows, which again has been gone through, and there's also the potential concern that it could escalate beyond the Strait of Hormuz too, and if it impacted the other side of it, could impact the Suez Canal route as well. And you've got the ongoing geopolitical uncertainty. So what does that mean for the agri-food sector? Well, it means the cost of doing business, energy costs directly and indirectly are impacted. Energy is a huge part of the cost base for any agricultural business, any farmer or agricultural service business. Given we are heavily energy users, either directly or indirectly. You got the fertilizer side of it. You got the cost of freight then as well, in terms of rerouting, availability, timing, and insurance premiums. And given that we export so much internationally, that obviously is a factor as well. And then you got the whole price of agricultural products, be it inputs, and then what impact it could have on output. Now, the output side of it probably take a bit longer, as Angelo pointed out earlier. And then you've got the whole other side of saying, well, if this thing is prolonged and it does impact economic activity and potentially from a worldwide perspective or internationally, economic growth is stifled, well, then that potentially could have a potentially negative impact in the medium term in terms of a demand of our own products. So, there's an awful lot of aspects to this that when you start looking under the bonnet. But I suppose just in terms of the costs, so we've done a bit of analysis on costs and what impact it could have in Ireland. But I think the first thing just to touch on here from an Irish perspective is that we're already operating in a very high cost environment. So when we look at what the cost increases are going to be, we need to look at them from a perspective of where we are already. So there's just two aspects that I'm just going to talk about. First of all, we look at the wage perspective. Ireland would have the second highest minimum wage in Europe, and significantly higher than likes. If you look at what the level of minimum wage is in the United States, it's substantially lower than where we are in Ireland. Now, it is important to say that there is some countries in Europe, particularly in Scandinavia, that don't operate a national minimum wage structure, and they would have high levels of wages. So if they had a national minimum wage structure, they would be up at similar levels to Ireland. But in terms of context, wage levels are high in Ireland, and economically we've done very well as a high standard of living, and associated with that is a high wage levels, which does impact agriculture. Again, you don't have to be employing someone directly for that to impact you. It'll impact the services that you're employing as well. And then we look at our electricity side of it. So if we look at electricity costs in Ireland, and these are based on the first half of 2025. This is the most up-to-date figures available on Eurostat. We're operating in 2025. Our electricity price was 43% higher than the European average. That's now in 2025, before we take into account the impact that this is going to have. And a lot of our electricity comes from gas generation. So, it's inevitable that electricity prices are going to be hit. It mightn't happen today or tomorrow, but it's going to feed through as this crisis unfolds, as we see gas prices being impacted, as Daniel touched off in his own presentation earlier. So we're coming from a very high cost base. And I suppose that's an important aspect to remember when we look at what potential impact it could have. And the other thing we spoke about in terms of we touched briefly about the CBAM side of it. What the CBAM has done in terms of its introduction is it has significantly disrupted the amount of imports of fertilizer coming into the EU and exports out of the EU. So if we look at what the level of imports that have come into the EU in terms of fertilizer side of it, the first 3 months of 2026, it's down about 2/3. So the first February there, but we got the first quarter figures yesterday from the European Fertiliser Observatory. We're down about 66%. Now, one of the main reasons for that was that there was a lot of fertilizer brought into Europe prior to the 1st of January, prior to the introduction of CBAM. So that was probably, that will be a help in the short term in terms of having fertilizer in Europe. But as the thing moves on, it is going to obviously have an impact as well in terms of where we source our fertilizer, particularly CAN coming in from outside of Europe into Europe incurs a higher CBAM charge than urea does. So I think CAN is going to be much more, we will be looking much more towards EU suppliers for CAN, which predominantly is the case anyway. We would have in 2024 certainly brought in, and maybe in Ireland, maybe 20% of our CAN that came into Ireland was from actually non-EU sources. So that certainly it has disrupted in terms of in that a lot of it may have come in earlier, and now we're facing a situation where, from a CAN perspective particularly, it's going to be much more expensive to acquire fertilizer from non-EU sources. So just in terms of the level of levies and taxes that are put on fuel in Ireland, then I just wanted to touch off this as well, just to give people an insight into it. So I've got 4 categories up here. So we have petrol, from a car perspective. I've got white diesel, which is what I'm looking at non-haulier or buses there. So if you're not in the diesel rebate scheme and you're using white diesel, then you've got the white diesel if you're a licensed haulier or a bus operator, because you get a rebate there. And then finally, green diesel. So if we look at the level of tax that's placed on them in an Irish perspective, so prior to the government package that was announced last week, nearly 73 cent of tax, this is excluding VAT, was on a litre of petrol. That was then reduced, and that is made up of three categories. You've got a non-carbon tax, which is excise. You've got a carbon tax, and you've got what we had a NORA levy, which is a levy for our National Oil Reserve Agency. So what has happened is that the government has suspended the NORA levy, the levy for the Oil Reserve Agency, for temporarily, I think, to June. And they also reduced the non-carbon tax on petrol by 15 cent, first of all. So what it meant was brought the price of petrol down by 17 cent. From a diesel perspective, for a non-licensed haulier or bus, it went from 63 cent to 21 cent, or 41 cents, so it dropped to 22 cent. For the haulage sector or rice buses, it went from 56 cent to just under 30 cents, so about 26.5 cent taken off it. And then from a green diesel perspective, there was 5 cent taken off it, much less than others. Now, the main reason that it was much less is because the government has been insistent on not touching the carbon tax aspect of excise. And because the fact that green diesel had less excise to start with, there was less to reduce. So very disappointing from a proportionate perspective. What was done for green diesel was a lot less. But it is, I suppose, at the same time, we do have to also acknowledge that even though there wasn't as much done, we still are operating at about 11.5 cent lower than what hauliers hauliers or bus operators are paying today. Now, as Bill has mentioned, there was a meeting this evening with the Taoiseach and the Minister for Agriculture, and I think that while there was no outcome that we can say, that we could point to this evening, there was a number of proposals put on the table from our perspective in terms of trying to help our members and obviously the contractors as well. And there will be ongoing dialogue with officials to see what we can do in terms of support package for our sectors. So in terms of, I suppose, just in terms of the carbon tax, then just to touch off it, the carbon tax that's in Ireland is a very substantial tax. It was introduced first in 2009 at about 4 cent a litre, excluding VAT. This is green diesel figures, for agricultural diesel figures, and it didn't really move anywhere from 2010 to 2020. It was still at 5 cent a litre in 2020. But in 2020, as part of the programme for government, for the previous government, what we have now, it was agreed that there was going to be a massive increase in the carbon tax put in place, and the 2020 Finance Act put that in place, but it also put it was legislated for, and there's programmed increases put in place. So it's basically going to go. What the program said was it would go from 5 cent plus VAT in 2020 all the way up to 19 cent plus VAT in 2030. So really, we're looking at, and the other thing is that we pay VAT on that as well. So obviously, if you can reclaim the VAT, great. But if you can't, you're paying VAT. So you're paying VAT on carbon tax. So it's effectively is a double charge. Now, the whole principle of carbon taxes is there's two principles to it. Alan has touched on it earlier. One of them is to try and equalise where there's unfairness in terms of intra-EU trade. But from an Irish perspective, the carbon tax on fuel was brought in to change behaviour. So the whole principle is you put a tax on fossil fuels to encourage people driving cars to switch to electric cars, or if you have a gas-fired electric heating, that you may look at going to other alternative forms, like if you're building a new house, you might go to air to water instead of looking at putting in an oil-fired system. But from an agricultural perspective, there's no other alternative. You can't run a tractor on anything other than green diesel. So we're a captive market. So it is inherently an unfair charge, because the whole principle why it was designed was to change behaviour. And the government then, I suppose, in a way to try and say, well, how to cover off that, people saying that, is that they said, well, we're going to fund the environmental scheme acres from carbon tax. And they point to that today to say, well, we're funding acres. But the reality is that we've had an environmental scheme in Ireland since 1994. And it's co-funded with the EU. And since from 1994 to 2020, it was funded from general taxation, the Irish exchequer contribution to any environmental scheme. So all that happened was they stopped using general taxation and they started using carbon tax funding. So it wasn't like that they pulled a load of new money and fired it into an environmental scheme. The money that's going into the environment acres in real terms is less than what went into reps 20 years ago. So that doesn't stand up to scrutiny when government representatives say that, and that has been said in the past week. So I think it's important to put that context to it. So in terms of, there is a capacity to get a carbon tax relief if you're farming, and that relief is effectively about you can avail of a relief of about 13 cent a litre in 2025. So you get relief at 13 cent a litre, but then that depends on what your reference tax rate is. So if you're paying higher rate personal tax, you may get up to 50% of that 130 euro odd per 1,000 litres. But if you're at a company, that's 12.5%. So it's a relief that you get in terms of the capacity to reduce your taxable profit. So now it is important to note that it is only farmers that can get that as of the current position. That it's clearly stated in the revenue guidance that you have to be carrying out the trade of farming, and agricultural contractors are therefore excluded from getting that relief as of today. So just, I suppose, to move on and to say, well, what's the potential impact? So what we did was, from a policy or the policy team perspective, was we looked at the main sectors in agriculture that are covered by the National Farm Survey. So we took the Teagasc National Farm Survey and we took the costs that were allocated there in 2024, because that's the most recent set of costs we can get our hands on. And then we looked at those categories and we put an estimated cost increase to it. So we're conscious, like, first of all, it was the 1st of March effectively when this thing started. So there was 2 months of the year gone, and then we have another 10 months on, and it's very difficult to say. You're looking into a crystal ball. So we just took a level that we felt was, we thought was a reasonable stab of what could happen. So we looked at this scenario where fertilizer costs for 2026 in total would be up 33%. That car, electricity and phone costs will go up about 25%. We're conscious electricity hasn't moved yet, so it probably won't be as it may be it'll be probably later in 2026 before we see that cost increase coming through. We say about machinery hire went up by 20%. Bulky feed, which is silage or hay purchase, if that's part of your budget, that would be up by 20%. Livestock AI and vet by 10%. Buildings maintenance by 10%. Other direct costs by 10%. We then inflated other overhead costs by 5%, concentrates by 5%, sprays by 5%, and we left interest, depreciation, land rental and hired labour the same. Now, I know people will argue about up and down about whether those figures are on the low side or maybe that or otherwise, but I suppose we have to start somewhere. So we've used those as a scenario, and we say, well, if those costs, if that happened, what would it mean for the main sectors? So effectively, what it would mean was that you would be looking from a dairy perspective, costs going up by about just under 5 cent a litre. So 5 cent extra for the Middle East crisis alone. From a tillage perspective, it's over 20 euro for a ton of spring. To produce a crop of spring barley, you're looking at about 22 euro per ton extra to produce that barley. You run a suckler cow, look at about almost €200 on a suckler cow. Obviously, there will be followers with that suckler cow, but that's your average farm based on the National Farm Survey. So there will be a blend of systems. If you're in non-suckler livestock, per livestock unit, you're looking about €120. And if you're in sheep, it's about €36. So they are, now people will say, well, the figure looks, maybe I thought it'd be higher. It's, remember, that's the additional cost that goes on top of an already very, high cost production systems we're in Ireland, owing to the characteristics that we have in terms of the price of energy and the price of wages. So not insignificant the increases are, and when you look at which are the very realistic, I think, cost increases that could happen as a result of the Middle East crisis. And I suppose in terms of what we're looking at from our perspective, well, we certainly feel on the carbon tax that something needs to be done on the carbon tax, because really, if you want to do something else for green diesel, you don't have really any more options. You've almost exhausted all the options on non-carbon tax. And so we do think that something should be done there. And like the other thing about it is, to add insult to injury, on the 1st of May, the carbon tax on green diesel is due to go up by another 2 cents. And we estimate that Irish farmers, since the introduction of carbon tax, probably paid somewhere around $1 billion, either directly or indirectly, on carbon tax from their farm businesses. And we would also call for a suspension on the CBAM and nitrogen fertilizers. I understand fully what Alan is saying, and it may be a case that doing that, then that the EU will need to step in and support some of the fertilizer companies if there is a temporary suspension of CBAM. It has been looked for at the council ministers on Monday at AgFish. Our own minister was one of the people calling for that suspension. And I think that given what is going on and the cost increases we're seeing, we certainly think that from the Commission does need to look at it. And if that means they do need to look at supporting the European fertilizer sectors to temporarily to allow that to happen, well, then fair enough. But we certainly do need to look at something being done from that perspective. So I think that's me, Robert and Bill, and I'm happy to hand it back to you now, and I'll stop sharing.
Perfect, Tadhg. We'll take questions for Tadhg there. If anybody has any questions, bring them in through the Q&A function at the top of the screen. And look, just when we still have nearly 170 people on the screen, I'll go through, in case anybody wasn't here to start the meeting, I'll just give an update. We had a meeting, the President, Francie, and Damien MacDonald and Robert Malone and myself, and the FCI, the main contractors association in the country, met Tadhg, who's the Minister for Finance, and the Minister for Agriculture today with their team. We had a very robust discussion, that's the polite way of putting it, around carbon tax. It did get intense enough. We still have to have a working relationship with them going forward. We left the meeting with them refusing to act on carbon tax. I think that's the best place to put it. We are looking at other solutions and other options. Look, one of the things that was discussed was that the contractors may get the same reliefs as we would get on carbon tax, which would be a small enough relief for them at the current cost of diesel. But if diesel goes back down to where it should be, it probably would be significant enough. It's mentioned in Tadhg's presentation that it's not eligible for contractors, so they would become eligible for that relief if the government can do that legally, and they're looking hard at doing that at the moment. Some of the other options that may be there was they may take a look at what diesel was costing before the crisis, what diesel is costing now, and there may be some gesture made to bridge some of that gap. But we just have to explore all options, see what's available legally. There will be some decisions taken in Europe in the coming weeks that may assist them in making those decisions. And it is a process. As I said, we did have a very strong discussion. I see people make comments that we're being walked all over and everything else. We entered the meeting in good faith. We left the meeting in good faith, and we'll try to work constructively with them for the moment. And I suppose that's the best way we can put it. We will explore other options after we give them time to take action on some of the discussions that happened today. We are recognised as an essential service. We did discuss the need for the country to maybe look at going to a 3-day or a 4-day working week for people that are in a position to do so. We have asked them to look at what supplies of diesel are coming down the line. And I suppose in particular, we're very worried about the supply of diesel, as was said in the earlier presentations. We're worried about the supply of fertiliser going forward, and we're worried about the cost of it. I can't be any more clear than that. There is a process to go through. We have another meeting coming up. We've emphasised the urgency of the crisis and the cash flow crisis that's there. We will have meetings with the banks on that as well, and on credit suppliers to the agricultural sector in tandem with the government. And we will have meetings with the government at a high level very soon again. They're continuing to engage, and we'll continue to engage constructively for the moment and see where that gets us. And I'm going to address there's a couple of questions stating prices of diesel going back where they were. Look, diesel is coming into the country at 120 a litre at the moment. We can deliver a certain amount. We can't deliver more than that. We will work as hard as we can to get as much as we can for both farmers and contractors. We'll go together to do that and work together to do that. And the government are listening to us, and they are trying to do something for us, and hopefully it will make a tangible difference sooner rather than later to the cost of diesel. So if there's any questions for Tadhg, Robert will go through here.
Yeah, no, I think a lot of the comments are in relation to carbon tax, and Bill has answered that. Like, we've got, they're just bound to keeping the carbon tax and the trajectory of the carbon tax increasing. So when we got that was our main ask, was the temporary suspension immediately of carbon tax, both from the Contractors Association and the IFA. The Taoiseach was very clear that's not on their agenda. It's not going to happen. So look, there is willingness to hear and to listen to other options that would reduce the cost. But carbon tax is staying where it is, and there's no immediate rebate or suspension. Unfortunately, we don't support carbon tax because it doesn't do one of the fundamentals, is to promote change of use away from carbon tax. There is no alternative to diesel for the agricultural sector by and large for machinery. It's disappointing, but we were told very clearly at the start of the meeting and throughout the meeting that carbon tax is not been taken away. So that's the main points that are coming up in the questions and have been.
And look, I'll address the question: if the government don't drop carbon tax within the next 2 weeks, what action do IFA going to take? We're going to engage with them constructively for the moment, and if we do take action, it will be through NOC and National Council in the proper way, and it will be through the county executives, and everybody will get to have their say there. But for the moment, we're engaging with them constructively, and as I said, we've entered the meeting in good faith, we left the meeting in good faith, and there is an open line of communication between us for the moment. Okay, Tadhg, you wanted to come in there? You have a hand up.
Sorry, just to say, I one of the figures I actually had, in my slide I said that the carbon tax is going to be 17 cents a litre in 2030. It's 17 litres today. That was a typo. It's if the projections or if the programmed increases continue, we'll go to 27 cents a litre by 2030. But I suppose one of the things that we have put out there in terms of potential option that should be explored is that during the previous Ukraine crisis, there was a temporary business energy support scheme put in place where businesses could apply once they were able to show that they had a substantial increase in their cost of gas and energy bills. They were able to then apply for support. So that's the sort of thing that we're going to continue to work and engage on, because I suppose if the government is saying, well, we want to continue to maintain charging carbon tax, well, then we have to look at ways that we can recoup it. So similar to that scheme in the past, something similar to try and say, well, okay, how do we allow farmers to be able to recoup it better than what's there at the moment in terms of the relief scheme, which, is cumbersome and it takes a long time to get the money back because you have to wait. You don't get it back till when you're paying your tax, which could be 9 months after year end. Yeah. So that's, I suppose, the key thing that we're going to keep working on to try and see, can we
just to comment on that, Tadhg, that was one of the main issues that we got a positive response on today. And I don't think we're saying too much coming out from the meeting. We did get a positive response on that being an option to be explored by the government. They're trying to see what avenues they can do. And just to be very clear on that, this is the position we'd be in. if there was an option of doing something like that, it would be ring fenced for agriculture solely, the agriculture sector solely. And they are looking on agriculture as a very important and essential sector to keep going. So I think it's okay to say that, and that's probably as much as we can say coming out of that meeting. So is there another hand up there, Robert? I'm sure we can try it in.
Yeah, there's somebody there with their hand up. If you want to speak there, I'll just try and let you in if I can.
Just on a relief scheme for diesel, that means you have to pay the high price and then try and recoup it. That's just messy. Why not work on the basis where you try and get a reduction on the price now, rather than going through a whole scheme of
just to be clear, we won't open it up to everyone. I'll take that as, but we made that point 10 times during the meeting, so we're very much aware that it's the current cost today, next week, the week after. That's the pinch point for us, more than the pinch point for us. That's the crisis point for us, and that's what we're trying to work on. We emphasise that at every point we could during the meeting, that it's today and tomorrow and next week, that the diesel is going to be bought for the silage season now. It's of the utmost urgency. And I think, look, we have a very quick meeting rescheduled with government, and I don't think there's many sectors would get another meeting as quick with them on this issue. It is very urgent. They understand the urgency of it. They understand the anger and the disillusionment. There's no point in using another word that's out there in the sector. And I don't want it to get across to that, because we are discussing everything, but I can't emphasize, look, we work very hard for farmers and for contractors in the meeting, and we're continuing to do that. And Tadhg has done a huge amount of work in the background as well on giving us the right figures. We were absolutely well informed going into the meeting. We had all the figures in front of us, and we made the correct arguments. And they conceded that they understand where we are, and we make sure that they understand where we are. They're not going to touch carbon tax, but we've emphasised the need that they need to do something in that magnitude to get people out of trouble. Okay, so I think we'll leave it at that. I don't think there's any more questions coming in, so we might leave it at that. The presentation is recorded if anybody wants to forward to anybody else afterwards, but I think we'll leave it at that for tonight. And thanks very much, everyone. Thanks very much to Daniel, to Alan, and to Angelo, and to Tadhg for the presentations, and for Robert for moderating the questions. And look, we'll close it down. It's 20 to 10 at night, and look, we'll be back out to county executives over the next few weeks, and we'll keep the lines of communication open to all members as we move forward with a plan. Thanks very much, everyone.